Good afternoon, friends. So, today we will be studying a very unique case study in the history of study of risk management, which is the long term capital management, LTCM, as you might have heard the name of. Has any one of you read about LTCM or knows LTCM? Good, yeah, exactly. Yes. It was in its own time in early 19s one of the well-known hedge fund, LTCM as it knows. The unique characteristic about this case study is that in the case of LTCM, there was no taxpayers' money involved, there was no politician involved, there was no fraud, no bankruptcies declared, nobody went to prison. But still, there was a run on this hedge fund. And the another unique aspect of this hedge fund is that in the board of LTCM, there were some very important names like Nobel Prize winners, economists, like Scholz, Merton, the people who were behind the formulation of the formula for option pricing. You have learned about this formula, Black-Scholes options pricing formula, Black-Scholes-Merton options pricing formula. So the people who developed that formula, they were on the board of LTCM. The investors of LTCM, they were one of the most sophisticated names in the financial industry in those times. UBS, Credit Suisse, Merrill Lynch, and executives from McKinsey, they were the investors there. And they were all HNI investors, means money was not an issue for those investors. And the strategy of LTCM was one of the most safest strategy to generate money. They had extremely complex formulas in their computer systems, and they used to identify the convergence trades. Now, what is meant by convergent trades? Convergent trades is they used to identify the mispricing among the related bonds. Mispricing means the two bonds which should move in a particular, the price of whose should move in a particular trajectory or in a particular fashion. So they used to identify the discrepancies in those price movement, and then they used to take positions in those movements. Means they were buying the bonds which were relatively cheaper to the price of the other bond, and simultaneously they were selling the other bonds. So in a way, it was a perfectly hedged strategy. They were trying to take advantage from the arbitrage and with no risk involved in that strategy. So ultimately, when the prices converged, and they used to make profit. Yeah. No risk in that strategy. And they were very successful for almost 4 or 5 years. Starting in 1993 until 1998, LTCM was really a successful hedge fund manager. And in a way means just before 1998, when the events happened, they had returned a significant amount of capital to their investors. Now, what happened in 1998? Sometime in August, Russia declared default on its debt. Now, remember LTCM, they did not have any direct exposure in the Russian bonds, or they have no relation whatsoever with the Russian debt. But the event of Russian default, it created panic in the market. And as we know, the flight to safety means investors, they were suddenly looking for safe investments in the market. Now, this resulted in the liquidity pressure on LTCM. Liquidity pressure means they were taking the positions in the market, as I told you, that they were buying the bonds which were relatively cheaper and simultaneously selling the bonds which were relatively expensive. These were derivative positions. So the margin calls started coming on LTCM. Now, due to these margin calls, there was a pressure on liquidity. And what happened at that time, the CEO of LTCM, he issued a letter to the investors giving them the option to invest more money in the LTCM at favorable terms. Now, this letter, it created panic in the market. Already there was an adverse news flow in the market. So the investors, they got the idea as if LTCM is in trouble, and resultingly the problem all started for LTCM, and ultimately the LTCM had to be bailed out, and there were investors who were found by the government, federal government at that time, and they then took over the LTCM, and then they repaid or they honored the debts of the LTCM. Now the unique part of this case study, my dear friends, the learning curve for this is that liquidity risk management is very important. And the another aspect, worst case scenario can materialize anytime. So friends, any questions on the floor, from the floor on this? Yeah, good, good. You know, the another thing for the LTCM means, you rightly said, there was, because they had such a huge reputation in the market that they were not asked to deposit any initial margin on their derivatives trade. So resultingly, all their trades were with zero margin. So even if they had ample liquidity, means in terms of the size of, they had $1 billion line of credit available to them at any point in time. But when the margin calls started coming, and the margin calls started coming so fast that even this $1 billion of liquidity line was not sufficient for them. So therefore, they had to be bailed out as quickly as possible at that time. Any more questions? Thank you, friends. I wish you all the best, and I request you all to do some Google search and study more about this LTCM case study. This is really one of the very interesting case study in the risk management. All the best to you.